As we look at the above consensus inflation data, most eyes are trained on the price increases at the pump, in the services sector, and at the grocery store. One area, though, that we think deserves more attention is housing. So why are we looking closely at the housing data? Let's break it down. Well, first, housing is a key component to the CPI, and that tends to drive both consumer and market expectations for inflations over time. Now, within the core CPI, that's excluding food and energy, housing has a 40% weighting. Housing is a strange component to the CPI, though, because it's both a good and a service. The index tries to bridge this gap by using something called owner's equivalent rent, or OER. It's an estimate of how much money a property owner would have to pay to be equivalent to their cost of ownership. This is difficult to determine, and we see that in the estimates. The estimates in this category are just very slow moving. They're much slower than what we see in the actual residential real estate market. That's where we have transactions that are marked to market every day. For example, we have experienced year-over-year increases in housing prices of over 16% in the first quarter, yet we see a much slower moving rate of change in the OER of just 2%. So the risk here is that this gauge closes the gap with market observations, and that may drive core inflation up substantially. Next, while there is a transitory element to the recent overshoot to the CPI inflation, some of the elements impacting housing may be longer lasting. We're all well aware of the supply constraints here, constraints around land and building permits, around access to skilled labor, and shortages of some key raw materials. The demand side of the equation may stay robust for quite a while based on some of the demographic data that we're seeing. Now, according to a recent study, there are 45 million people in the U.S. between the ages of 30 and 40. That's an increase of 3 million from 5 years ago. This may drive an increase in new housing formation, and it's happening at a time when inventories are lean and the cost to build homes is high and rising. Now, single-family housing starts peaked in 2007 at 1.7 million units in the U.S., but plunged after the global financial crisis. Now, the pace has risen, but the March data shows us at just 1.2 million units, still well below peak levels. And last, why does it matter? Well, monetary policy has had a direct impact on the housing market. The monthly mortgage-backed security purchases and the low-rate environment have made mortgage affordability very high. Both have proved dry tinder to the burning flame of demand, and the demand's been driven not only by low rates and COVID-related moves, but also by these longer-tail demographic trends. If the Fed needs to tap the brakes on the housing market, there are broader implications for the market and for the economy. But right now, the housing data does not impact our longer-term outlook for low inflation, but it's certainly something we're going to be watching very carefully.